Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Today, it's all about mid-cap stocks, companies that many of us know, but often don't get the same attention as their large-cap peers. I want to find out what to look for, how to spot the opportunities in this section of the market. Remember, the information in this episode is general in nature. It doesn't take into account your own circumstances. Jack Briggs is Portfolio Manager of the Ellerston Mid-Cap Opportunities Fund, which is working with Sodor Capital, a great supporter of this podcast. He joins me in the studio. Jack, welcome to Fear and Greed.
Thanks for having me today, Sean.
So give us a quick overview of mid-caps. What are they? How do you think about investing in them? What's your process? Kind of a 101.
Yeah, great. So the way that we define mid-caps at Sodor Capital is a market capitalisation of between $1 billion Australian and $20 billion Australian. And if you look at the indexes, that roughly aligns to the ASX 50 starting at the top all the way down to the ASX 300. So around 250 stocks in that universe. And we also invest in New Zealand of corresponding size. So the Ellerston Mid-Cap Opportunities Fund is our vehicle to invest in that space and target those businesses. And so we own 35 of those stocks across the fund. It's a long-only, bottom-up fundamental process.
So let's just break that down. Long-only, basically you're in it for the long term. You're not trying to trade every day.
Long only in the sense that we're not taking short positions in stocks. So we're benefiting from share prices appreciating rather than dropping.
Yes.
Yep.
Okay.
And then stylistically, we look for the best opportunities wherever they may be. So we're not getting stuck into value versus growth. We're doing a bit of both. We're looking for the best risk rewards wherever they may be at present.
Okay. So you must have parameters, though, about how you think about there's 250 stocks. You've picked 35. What have those 35 broadly got in common?
So the way that we think share prices end up being mispriced is when the market doesn't appreciate the future earnings potential of that business. So how we get to that conclusion is we go and do the deep bottom-up fundamental work. We spend a lot of our time traveling. We spend a lot of our time out and about meeting the companies. We want to meet not just their executives, but also numerous other sort of employees across the business within those companies. We want to meet their competitors. We want to meet their suppliers, their customers. If there's a regulator or a consultant involved in the industry, we want to hear their perspective. And we blend all of that together to forecast future cash flows for those businesses. And we're looking for situations where we think the market has underappreciated the earnings potential of that business. We've done all our deep fundamental work. We think the current valuation isn't implying the same thing. And we think the market will come to agree with us over time and the share price will appreciate and will benefit.
We'll get to some stocks in a moment, but are there certain attributes that you must have? I suppose management is one, founders or strong management. Are there other things that all these companies have once you've done this work? Yeah,
it's a great point, Sean. Management's a really key one. So part of our fundamental work, we'd have a number of pillars that we evaluate a company on, management being one. One of the things we look at for management is how they set the strategy. So a strategy is a business has a series of resources and capabilities, and then there's a market opportunity, which is external to the business. And your strategy is trying to use your resources and capabilities to produce the highest return on your incremental invested capital as you exploit that market opportunity. And generally, we find when businesses are producing high incremental returns on invested capital, that's a pretty good hunting ground for mispriced stocks where we might make an outsized return.
How much of this is financial? So you might invest in a miner, you might invest in a financials, as a bank or something like that. You might invest in a retailer. You probably invest in all of those things. You can get your return on invested capital through the balance sheet. How much of it, though, is about understanding the business, kind of visiting a retailer, realizing, how many people are on the floor there, that type of thing?
Yeah, I think our best investments, and on average, we try to look for this in every single investment, but our best investments are definitely the ones where we have some underappreciated aspect of our analysis that's based on robust data that we can validate and we can know is true to a high degree of certainty. We then reflect that in our forecast for the future cash flows, and we come up with, as I was talking about, a differentiated view on that business's earnings power. So to answer the question, it's always better when you can turn it into a quantitative assessment, and that's not always possible, and often you're operating with degrees of uncertainty, and that's what makes the job a little bit of art and a little bit of science, and that's what keeps me engaged every day and waking up and running into work to do that work and to really sort of solve those problems.
You've got a 2-year-old.
Yeah,
that's
right.
Keeping you up at night. That's what made you hesitate when you were saying that. But yes,
that's right. Work's my safe place.
Very true, Jack. Stay with me. We'll be back in a minute. My guest this morning is Jack Briggs from Ellerston Mid-Cap Opportunities Fund. Ahead of the break, we spoke about the process. Let's talk about some stocks. So of those 35, can you give us a few that you like? So let's start with, you choose.
Yeah, great. So one of the ones for today, Regis Healthcare, ticker REG. So they own 69 and operate aged care facilities around Australia, around 7,500 beds capacity. And so we like Regis Healthcare because it's got a structural tailwind. Obviously, the baby boomers are aging. They're moving into that demographic that requires aged care. The Department of Health forecasts we need 10,000 beds per annum of new capacity being built to house all of those that require care. But at the moment, in the last 4 years, we've only built 1,500 beds per annum. So there's a massive supply and demand imbalance, and that's seen occupancy almost at breaking point now. The reason for that gap, in our view, is the returns aren't high enough to justify building new facilities as much better uses of capital. And so the government needs to fix that by coming in, and it's a heavily legislated centre. These aged care providers can't just go and charge more. It's the government decides all of that. They need to improve the economics either with more copay or with more incentives from the government themselves. And we think that that's the only answer for this issue. You can't have them in public hospital. That costs 4 times as much. There's not really an alternative. They need a high level of care. The government needs to make it better for operators. And we think that benefits both Regis's existing portfolio of assets, expanding their returns, and also allows them to build new assets at returns that are attractive to us as investors as well.
How do you know it was Regis? I was just looking at the share price as you were talking to me, and it ran up in 22, 23.
Yep.
It was good kind of May, June this year. It's come off a little bit. How do you know when the share price is the right time to jump in? Now, presumably you're holding this anyway, but for a new investor, how do you know when to jump into Regis?
I think when we look at our process, it all just comes back to we've done the work to understand the business as best we can. We've spoken to industry consultants, to the other players in the industry. We've looked for alternative points of view. We've tested why we might be wrong. And we've brought all of that back to our financial forecasts. And we've said, okay, we think that there's an underappreciated earnings potential here. And we've turned that into a valuation. We think Regis could trade to $12 to $14 per share on a 2 to 3 year view. And so at prices below that, we're happy to accumulate shares unless something changes and we get proven to be wrong, which happens from time to time. We reevaluate it at that point in time. So I think if I can emphasize one thing, it's that deep fundamental work. It's getting busy going and seeing companies, understanding the businesses, understanding why you might be wrong, that we seek to really differentiate ourselves in our analysis.
Okay, so Regis, $12 to $14, it's about 7.5 now. What about away from Regis? Give us the second one.
Yeah, so we're going in a pretty different direction. Seek, so ticker SEK. So many of us will be familiar with the brand. Obviously, the leading sort of online job ad marketplace, both in Australia but also New Zealand and throughout Southeast Asia. Seek's the classic story of a really high quality company with a really embedded moat, being the leading player in a heavily branded marketplace industry. Difficult to disrupt that moat, but it's had some short-term issues that have seen the share price quite weak over the last 2 to 3 years. So the first being macroeconomic settings been wrong for them. So unemployment rising is negative for the number of ads placed on Seek. It's been negatively correlated historically. And then secondly, Seek embarked about 3 years ago on what they called their unification program, which is seeking to align the tech stack of all those different geographies. They're all operating on different tech, way too hard, trying to innovate when you had to do it 6 times. They just wanted to collapse it all together. That cost a lot of money, as you'd probably guess. Mm-hmm. And we think they're past those 2 issues now. We think the rate of increase in unemployment and decline in ad volumes is starting to decelerate. With having rate cuts, we think that becomes potentially a tailwind where unemployment starts to drop. You get more ad volumes in the next 6 to 12 months. And then secondly, on the technology side, Seek's through that program, costs and CapEx have dropped materially. And now we're starting to see the benefit on the revenue side. We've seen product innovation really jump. And topically, it's probably one of the most tangible AI stories in the near term that we found. Seek have had an AI team for a number of years, well before ChatGPT became into everybody's lexicon. And we think that there's big opportunity to increase the matching of those candidates and the jobs together. And there's a lot of upside in being able to charge more if you can create more successful outcomes for hirers.
What amazed me, and I'm not supporting Seek or taking away from it, last week, Fear and Greed put up an ad for a business journalist, and it wrote the ad, it it was such a seamless process just to get out there. We paid our $900 or whatever it cost us. And, we had enormous sort of follow through from that. But it was all AI generated. And so as a user, it was incredibly easy. Okay, so we've done Regis, Seek, a third and final one.
I think if I look at the portfolio today, maybe trying to go in a slightly different direction, we like Aussie Broadband a lot. So obviously, again, a household name. Many of us would be customers. They have the Aussie Broadband brand for consumer, and then they have some business and wholesale telecommunications platforms as well. We think the structural growth of basically everybody who's not Telstra and TPG is here to stay, with better service outcomes and better price being offered to consumers, and what is a commodity service in terms of the actual quality of the network. And Aussie's been taking market share quite strongly for some time. We think the rationality in the market is being underappreciated. Obviously, as a commodity product, you often see price competition, and that can be bad for returns. We think the players are exhibiting quite high price rationality, and that should see margins and returns expand in the short term, and we think the market's underappreciating that. Balance sheet's in great shape. We think the valuation is quite cheap at around 7.5 times EBITDA for FY26, and we think that has room to expand based on where some of the peers are trading and the growth profile of the business.
Jack, thank you for talking to Fear and Greed.
Thank you very much, Sean.
That was Jack Briggs, Portfolio Manager of the Ellerston Mid-Cap Opportunities Fund, which is working with Sodor Capital, a great supporter of this podcast. Remember, information in this podcast is general in nature, and you should always get professional advice and make sure a product is right for you before proceeding. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, business news you can use. I'm Sean Aylmer. Enjoy your day.